Hello everyone, my name is Vandita and thank you for joining me back on my channel. I have been extremely busy and I know I have not been answering your questions for quite some time, but I'll try to take them up now. Let's start with the first question that is coming from Abhishek. So he has just mailed me this question. He wants to know, what are the mistakes usually done by an investor when it comes to investing? Well, it is a very, very relevant question, Abhishek. Thanks for bringing this up. It looks like a very repetitive question, but no, every time we look into it, definitely this is one thing that is always in the mind of investor, in the mind of advisor, that, oh my God, why are the investors not following this? So, okay, number one thing is constantly watching the markets. Okay, I say it's okay when you are creating your portfolio, looking at the market timings and all. That's okay when you're creating a resilient portfolio. But once you have done your due diligence, you have decided to pick up the stocks, you've decided to pick up the funds, why do you want to really look into the markets every day? See, every day if you look at a particular stock, it will not be in green shoots every day. It will have its own time. It will take some of its time to grow, right? You don't have a perfect day every day, right? So every stock will have its good and bad days. We need to accept that stock the way it is because we have done our due diligence. We think it has got its value in a particular thing, or it could be any stock, and it has got its value, and we know that it will generate alpha in the coming years. So we need to wait, be patient, let it grow, and we need to benefit from the power of compounding in its ups and downs, right? So let's wait and let's not watch our portfolio every day. Let's keep it on a quarterly basis once we've created a resilient portfolio. So let's hang on to this. This is the first mistake that an investor does, and we'll try to rectify it, okay? Let's move on to the second mistake that I've noticed. Is that people are having this fear of missing out, which usually is known as FOMO. You know, they keep on chasing the trends. They see that, oh my God, yes, we know cryptocurrencies are doing very well and they've given very good return to their investors. But then the new cryptos that are coming every day in market. And, you know, people have this FOMO thing that, you know, maybe I'm missing out on this, maybe I'm missing out on that. No, you're not missing out on anything. Every day you will have new things in the market. You need to be constantly aware what your goals are, where you are heading, and what you need to really work on, which investments you need to go for. And because we have made our portfolio, we have done the due diligence, so let's not get into this chasing the trends every day, right? We'll see it after 4 months. If our portfolio is not doing well, we need to work on it, then definitely we'll look into various things, but not before that, right? We need to be confident and believe in ourselves and how we have constructed the portfolio. We need to trust on that if we have done the right asset allocation. All right. The third thing that I've noticed is, looking at the returns and not looking at the risk-adjusted returns. What I mean to say is a couple of points here to discuss. First is that we look at the greater thing that, oh, this portfolio is giving me 20% returns in the next 1 year. So why not to go for that? But you are looking at its past returns. But I have always told my clients and my people that please don't look at the past returns only in the good times. Look at a stock, look at a fund, but see how it has done in the bad times, because that will define the right fund and that will actually create the right alpha. Right for you when you invest in that fund. Not like that कि ठीक है इस fund ने तो हमेशा से अच्छा किया है, then you should invest. But अगर उस fund ने कभी अच्छा नहीं किया, कभी बुरा किया है, but then when did it not do well? Is it when the markets were up, everything does good, right? But when markets are down, the fund or the stock that really does not do good is the right fund for you to invest in. So my thing here to you would be, please invest wisely. So my last comment here would be, focus on returns, but on risk-adjusted returns. Do not really look for something and go beyond your near-term goals. If your near-term goals are easily met by 12% returns, then why to take unnecessarily risk as well, you know? Just go for that 12%. No, why do you want to look out for 15 or 20% returns when you can actually meet your goals? So don't miss out on your goals as well. So that's another takeaway on that front. But moving on. The next important thing that people miss on is the fund manager expertise. We all know mutual fund is a beautiful instrument. Everyone keeps saying that. But what is the major beauty of mutual fund is the fund manager expertise that we get in terms of the expense ratio that we pay. Now the thing is, which category is the most important category in this fund, on this front, where we could use maximum fund manager expertise? Well, I would say it has to be balanced advantage category. Asset allocation is a very, very, I would say is of prime importance there, where your money is getting allocated along with market valuations. So that expertise a fund manager has. When the markets are very high, fund manager would reduce your equity exposure. When the markets are at its low, they would increase the equity exposure because they know how the markets work, how they could give you beautiful returns, a consistent return portfolio. Now, some fund managers and some fund managers from different fund houses, they have different kind of strategies to work on that. But as an investor, I think that and as an advisor, I would definitely recommend you to, incur some money in these categories. There is a category called multi-asset category. There's a category balanced advantage category. Here you can actually use fund managers' expertise of equity valuations along with the markets, because we really don't know how the hedging is done on a larger level, but they really understand that part. And if you're not at all informed, then definitely you can stick to mutual funds. But if you're even little informed, and if you don't want to invest via mutual funds, still you should take the benefit of the balanced advantage category and the multi-asset category that fund houses offer. Now, in the multi-asset category, you tend to invest in various asset classes. So when equities are not doing well, the fund manager will put your money in gold. They will put your money in debt, in REITs and InvITs. So the various ways with which they would diversify your portfolio, along with sectoral diversification, you will get asset diversification as well, and which is very important for an investor for getting that kind of resilient portfolio. We know gold is not doing well from last 1 year, but we know that it will do good. We have gold reserves, and gold is a very, very important asset, and we must put some money in the gold asset class as well. So this way you can actually invest less, but you can get maximum benefits, and of course you get a fund manager expertise. So it's always good to have some money in balanced advantage and these multi-asset category. You must have some kind of allocation in these categories when it comes to mutual funds. Now, a lot of people have also, commented and asked me that which fund houses to go for. Now, see, the fund house that you have to choose, when it comes to these category, must meet your risk appetite. Now, see, how to find it out? It's very simple. If the equity allocation is too much, if it is above 50, above 60, clearly it's a aggressive fund house, and the fund manager thinks in an aggressive way. It's a strategical, and definitely the fund manager is looking at the risk adjusted returns, but from an aggressive angle. So now, as an investor, I need to look at my risk appetite. If I am little conservative and I'm not okay with it, then I won't go for it. There are certain fund houses, say Nippon, Motilal. Now, Nippon AMC, they give you, when you invest in their balanced advantage category, multi-asset category, they give you international exposure as well. Now, if you want to, benefit from dollars and INR and pounds and euros, then you might want to really benefit from it. But if on the other side, I don't want to really touch upon it, then I'll stay away from that fund house. Then if I want to get benefits from ETF, then I would want to invest in Motilal as well. So these are the things that you as an investor would decide for yourself, right? But these are some mistakes that I would say a lot of people usually do when it comes to investments. They don't look at really what is going on behind. They just look at social media, okay, it's in hype, and they just they read a single news But look at that company's vision, look at everything, look at all the angles, then choose it. Just don't go for a single return factor and invest, all right? And on that note, thank you very much for listening to me today. I'll take a leave now, and I'll try to be regular now as well, right? Thank you again very much for listening to me.